You are locked in to Talk Tickers. This is the deep dive where we strip away the corporate gloss, ignore the PR fluff, and get straight to the raw numbers.
Well, the numbers that actually move markets.
It is Wednesday, January 28th, 2026.
And today we are wading into a sector that has been absolute torture for the faint of heart. Regional banking.
It really has been the battleground, hasn't it? If you're trading this space, your cortisol levels are entirely dependent on the Fed's rate path.
Oh, yeah. Are we getting cuts? Are margins getting crushed?
That's a commercial real estate apocalypse about to blow up the balance sheet. It feels like we've been having the same panic attack for, 2 years now?
That is the narrative loop we've been stuck in. But specifically today, we are looking at Hope Bancorp, ticker symbol HOPE.
And this one is fascinating because we have a classic setup. I mean, we have a management team that just delivered a beat on the bottom line.
Yep.
They gave us bullish guidance for the rest of 2026. But the tape is telling a very, very different story.
It's a good news, bad price action scenario. And usually when the market ignores good news, you have to ask yourself, is the market broken or does it know something I don't?
Spoiler alert.
Yeah.
The market is rarely broken.
Yeah.
But let's try to figure out what it's seeing. Let's start with the price action because it has been Whiplash City.
Whiplash is the right word.
So earnings dropped yesterday, January 27th. The stock pops. It closes at $12.16, up over 3%.
Up 3.23% to be exact.
And the volume was real. We saw 1.07 million shares trade hands. That is roughly 31% above their 10-day average.
That's conviction. That's people reading the headline numbers and just hitting the buy button.
Exactly. They were buying the print. But then today happened. As of the close today, January 28th, stock gave it all back. All of it. Closed at $11.76, down 3.29%. We are essentially right back where we started before the release. So the million-dollar question, why the fade?
To understand the fade, you can't just look at the last 24 hours. You have to look at the run-up. You have to contextualize the trade.
Right. Context is king.
If you look at the month prior, from late December through yesterday, Hope had already run up 8.6%.
Which, for a boring regional bank, is a massive move in 4 weeks.
It is huge. I mean, compare that to the S&P 500, which was up maybe 1.1% in that same window.
Right.
Or even the regional bank ETF, KRE, which was up 3.5%. Hope Bank crushed the benchmark and its own sector.
So the smart money was positioning for this beat weeks ago.
Precisely. The market essentially priced in a perfect print before the PDF even hit the wire. This is buy the rumor, sell the news 101.
Right.
The expectations were already baked into that $12 handle. So when the news came out, even though it was objectively good, the incremental buyers were exhausted.
The sellers were waiting.
The guys who bought in December, they used that liquidity spike yesterday to sell into strength and book their vacation money.
That makes perfect sense. It's classic exhaustion. But let's unpack the news part of that equation, because despite the sell-off today, the actual P&L, the profit and loss statement, it looked pretty robust to me.
It did. It really did. If you strip away the stock price and just look at the business, they had a great quarter. Net income came in at $34 million for the fourth quarter of 2025.
And for context, that's up 42% year over year.
And perhaps more importantly, for a cyclical business, it's up 12% quarter over quarter. Sequential growth is what we really care about when we're trying to spot a turning point.
And this wasn't just financial engineering, right?
No, not at all. Sometimes you see a bank beat earnings because they fired half their staff or got a one-time tax credit. This wasn't that. This was driven by real net interest income growth and some surprising strength in fee income.
Okay, let's drill down into that net interest income, or NII. Because for the listeners who don't speak banker, this is the engine room.
It's
the difference between what the bank pays to borrow money, usually deposits, and what they charge to lend it out. If NII isn't working, the bank isn't working. What are we seeing with the margin?
The net interest margin, or NIM, came in at 2.90%. Now, sequentially, that's up 1 basis point.
1 basis point, that sounds tiny.
In a vacuum, sure. But in this environment where the yield curve has been fighting everyone, stability is a victory. But look, year over year, it's up 40 basis points.
Okay, that is significant. 40 basis points is a massive expansion in a year where everyone was terrified of deposit costs just spiraling out of control. How did they pull that off?
It's a function of funding costs dropping faster than asset yields are compressing. They gave us a data point that I think is the most important number in the entire deck.
What is it?
The spot rate on total deposits as of December 31st stood at 2.68%.
2.68%. Wait a minute. Treasuries are yielding more than that. I know peer banks that are paying 4.5% or 5% just to keep customers from fleeing to money market funds.
I know, right?
How is Hope Bank paying less than 2.7%? Who is leaving their money there?
2 words. The Hawaii factor.
Ah, right. The acquisition. We have to talk about this because it really distorts the comparison, doesn't
It
it?
changes the whole complexion of the bank. They closed the acquisition of Territorial Savings Bank back in April 2025. That deal is the primary reason you see gross loans up 8% year over year and deposits up 9%. You can't look at that 42% net income jump and think it's all organic growth. A big chunk of that is simply buying a bigger balance sheet.
But acquisitions are notoriously messy. You buy a bank, you change the sign on the door, and suddenly all the grandmas take their money out because they don't like the new logo.
That was the risk, deposit attrition. But management confirmed on the call that there has been no meaningful deposit outflow in Hawaii. Operations are stable.
So they bought a sticky deposit base.
They bought a fortress. Think about the geography. In Hawaii, banking relationships tend to be incredibly long-term.
Right.
Money doesn't chase yield quite as aggressively there as it does in, say, New York or San Francisco. So Hope Bank effectively imported this massive pool of cheap funding that allows them to keep that cost of deposits at 2.68%.
That is a serious competitive advantage. While everyone else is fighting a price war for deposits, HEP is sitting on a beach sipping cheap capital.
That's the bull case right there.
Okay, so the income statement is solid. But whenever I look at a regional bank in 2026, my eyes go straight to the asset quality. I'm looking for the cracks. I'm looking for the office towers that are half empty. Where is the credit cliff?
That's the regional bank worry, right? Commercial real estate, specifically office space, everyone expects the other shoe to drop. But here is where Hope Bank really bucked the trend.
Hit me with the stats.
Criticized loans totaled $351 million.
Just to define that for everyone, criticized loans are loans that the bank has flagged as potentially risky. They aren't in default yet, but they're on the watch list.
Exactly. They're the ones the bank is nervous about.
The problem children.
Right. And $351 million sounds like a big number, but context is everything. That number is down 22% year over year and down 6% just from the last quarter.
So the pile of problem loans is actually shrinking.
Rapidly. And if we look at actual losses, net charge-offs, meaning money they actually gave up on collecting, it was only $3.6 million for the quarter. That is 10 basis points annualized.
10 basis points.
Yeah.
That is barely a rounding error.
It's pristine. For all the doom and gloom about a recession or a credit cycle turning, it simply did not materialize on Hope Bank's balance sheet in Q4.
That is impressive. It suggests their underwriting was a lot more conservative than some of their peers who are currently sweating bullets over downtown office space.
Or they've just been more aggressive about working those loans out. Either way, the credit cliff isn't here.
One other thing on the revenue side that caught my eye, swap fees. This felt like a nice little bonus.
Yes, the green shoots.
They pulled in $6 million in swap fees for the full year. That is up 270%.
This is crucial because it shows revenue diversification. They aren't just relying on lending money and collecting interest. They are getting better at fee-based income. When you can sell a client a rate swap and book a fee, that boosts your return on equity without using up your balance sheet.
It helps smooth things out.
Right, it smooths out the earnings volatility.
Okay, so Q4 was good. The past is good. But markets trade on the future. And this is where things get really interesting and maybe a little controversial. Management came out swinging with their guidance for 2026.
Swinging is the right word. This is aggressive guidance. They are calling for 15% to 20% revenue growth in 2026.
Hold on, 15 to 20%. For a regional bank in this economy, that sounds ambitious.
It does.
Bordering on delusional.
It's a very big number. And they're guiding for pre-provision net revenue, PPNR, to grow 25% to 30%. They are expecting loan growth in the high single digits. They are essentially telling the market we are in full-on growth mode.
What are they smoking? I mean, what are they assuming about the macro environment to get those numbers? Are they expecting the economy to suddenly roar back to life?
Not necessarily booming, but they are betting on the Fed. Their budget explicitly assumes 2 Fed cuts in 2026, one in June and one in September, 25 basis points each.
That seems reasonable. It aligns with the forward curve.
It does, but the real juice in the guidance isn't the Fed cuts. It's something specific to their balance sheet. It's the repricing tailwind. This was the most important detail in the entire call, in my opinion.
Break it down for us. This is the technical stuff that actually makes money.
It's all about the CD certificates of deposit. The CFO, Juliana Bisca, gave us the roadmap. They have about $2.5 billion in CDs repricing in Q1 alone.
$2.5 billion rolling over. What's the spread?
The old paper, the CDs that are maturing and falling off the books right now, is costing them about 3.99%.
Okay, almost 4%.
Right. But the new branch CDs they are issuing to replace them, they are coming on at 3.75% to 3.80%.
Oh, wow.
And the institutional paper is even cheaper, around 3.70%.
Wait, so just by the calendar turning, they're swapping 4% debt for 3.7% debt.
Exactly. It is free margin expansion. They don't have to do anything but answer the phone when the CD matures and roll it into a cheaper rate. That spread differential goes straight to the bottom line. It's a built-in profit booster for the first half of 2026.
That explains the confidence in the net interest margin expansion. It's mathematical gravity.
Yeah.
But I have to play devil's advocate here.
Please do.
Usually when a bank talks about growth, they also talk about efficiency. If they're growing revenue by 20%, are they spending 20% more to get it?
This is where the bear case starts to creep in. This is the fly in the ointment. Their efficiency ratio right now is 68%.
Oof. 68%. So for every dollar of revenue, they're spending 68 cents just to keep the lights on and pay the staff. That is heavy.
It is heavy. Industry standard for a high-performing bank is usually in the 50s. Management has a medium-term target to get that down to the mid-50s.
That is a long way to go from 68%.
It is. And to their credit, they were honest about it. They admitted that reaching the mid-50s is going to take more than 1 year.
Okay.
They aren't slashing costs to get there. In fact, they are explicitly prioritizing hiring.
Hiring.
Yeah.
In 2026.
Yes. They are hiring frontline revenue generators. Commercial bankers, relationship managers. The CFO said OPEX growth operating expense would be in the low single digits, but the focus is on adding heads, not cutting them.
So the play here is operating leverage. They want to grow revenue so fast that the expenses look smaller by comparison.
That's the gamble. They aren't trying to austerity their way to profitability. They are trying to grow their way there. It's a bolder strategy, but it carries much higher execution risk.
Right.
If that revenue growth stalls, if they only grow 5% instead of 15%, you're stuck with a bloated expense base and that efficiency ratio stays ugly.
It feels like they are walking a tightrope. If the economy slows down more than they expect, that hiring for growth strategy is going to look like bloat very, very quickly.
Absolutely. And that brings us back to the investor context. We have a stock that popped on the print, faded the next day, and is sitting on a valuation that demands perfection.
That's the rub. The 8.6% run-up in January priced in the NIM expansion. It priced in the good news. Now, the market is looking at that 15-20% revenue growth target and saying, show me.
It's a show me stock now. The multiple expansion is done. Now they have to earn the valuation.
But they do have some levers to pull if the stock languishes.
Right.
It's not just hope and prayers.
No, capital allocation is shareholder friendly. They reinstated the share buyback authorization. They have $35 million remaining on that.
That's a decent backstop.
It is. And they declared a dividend of 0.13 cents per share payable on February 20th. So you are getting paid to wait. They're signaling they have excess capital.
Right.
They aren't hoarding cash because they're scared of a credit event. They're comfortable enough to hand it back to shareholders.
So connecting the dots here.
Yeah.
Why the fade? Is it exhaustion?
It's valuation versus reality. The efficiency ratio of 68% is a weight around their neck. The market hates inefficiency. And while the growth story is exciting, it's just a story until the numbers hit the board in Q1 and Q2.
It's just a promise.
It's a promise. And if loan growth comes in at mid-single digits instead of high single digits, that operating leverage turns into an operating drag very quickly.
So the market is hedging its bets. They like the quarter, but they aren't ready to marry the guidance.
That's it in a nutshell.
All right. That covers the fundamentals. We've looked at the P&L, the balance sheet, the guidance, and the macro. But this is talk tickers. And we don't just read the news.
No.
We like to think about how to trade it.
This is the part of the show where we take the gloves off.
That's right. It is time for our This Is Not Financial Advice segment.
Disclaimer time. We are not financial advisors. We are two voices on a deep dive. Do not trade based on what we say. Do your own diligence. If you lose money, don't email us.
Okay, with the lawyers happy, let's get weird. I'm looking at this set up stable Hawaii deposits, repricing CDs, pristine credit, and I'm seeing a pair trade. I'm calling this the Aloha spread.
The Aloha spread. I like the branding. What's the pitch?
The pitch is a long-short equity play. We are going long Hopeful Bancorp, and we are shorting a mainland regional bank peer with high office exposure.
Okay, walk me through the logic. Why long hope specifically for this trade?
It's a NIM divergence play.
Yeah.
We know for a fact, based on the call, that Hopi has $2.5 billion in expensive CDs rolling off into cheaper paper.
Yep.
That is mathematically guaranteed margin expansion.
Locked in.
Locked in. Plus, you have the Hawaii factor. That deposit base is a fortress. It's an island monopoly. Money there doesn't chase yield the same way it does in New York or San Francisco. It's sticky.
Okay, so on the long side, you have margin expansion and sticky funding. Why the short side? Why not just buy hope and call it a day?
Because I want to hedge out the sector risk. I don't trust the banking sector as a whole. So you find a peer, maybe a bank in the Northeast or the Midwest, that is sitting on a mountain of office CRE loans.
Okay.
Because while Hopi's criticized loans are down 22%, the industry average is not that pretty. There are banks out there pretending their office portfolio is fine when it's actually burning.
And those banks likely have sticky high funding costs.
Exactly. They are fighting for deposits, paying 4.5% or 5%, while their asset yields are stuck. So their margin is compressing while Hopi's is expanding.
So you're betting on the divergence. Hopi's margin goes up, the peer's margin goes down.
Correct. And here's the kicker, the buyback.
We $35 million.
Management told you they have $35 million to spend. If the stock dips, like it did today, you have the company's own treasury desk potentially bidding the floor. You are effectively front-running the buyback desk.
That is interesting. So you have a defined floor on your long position, thanks to the buyback.
Right.
And you have uncapped downside potential on the short position if the CRE market finally cracks.
Exactly. You are hedging out the macro risk. If all banks dump, your short pays out. But you're betting on OP's specific idiosyncratic alpha, the island moat, and the CD repricing.
It's aggressive. It's wild. But frankly, the math on the CD repricing makes it plausible. You're trading the spread between an island fortress and a mainland trap.
The Aloha spread. Remember, you heard it here first, and for legal reasons, it was a joke.
A very detailed, mathematically sound joke.
All right, let's wrap this up. Recap for the listeners who zoned out during the efficiency ratio talk.
Hope Bank Q4 2025, they beat on the bottom line with $34 million in net income.
Credit quality is actually improving. Criticized loans are down, bucking the sector trend. They aren't holding the bag on bad office loans.
Margin expansion is locked in for early 2026 thanks to those CDs repricing lower. That is the safety net.
But the market is tired. The stock popped 3% and then faded 3%. The easy money has been made.
Now it's about execution. Management is betting the house on 15-20% revenue growth. They are hiring, not firing.
It's a bold strategy.
In 2026 is a very bold strategy. If they hit it, this stock re-rates higher. If they miss, that efficiency ratio is going to hurt.
And that is the gamble. Keep your eyes on the revenue growth and watch that efficiency ratio. If it doesn't start moving towards 60%, look out below.
And watch the tape.
Always watch the tape. This is Talk Tickers. We'll see you on the next print.
Class dismissed.